Welcome to The Explainer. Today, we're diving into an incredibly rich earnings conference call Transcript that provides a detailed overview of KFin Technologies, which we'll be graphically breaking down to understand their massive Q4 FY26 results. If you follow fintech or wealth management plumbing, you know KFin Tech is an absolute giant. Let's get right into it and unpack both their wild growth and some of the complex headwinds they're navigating.
Okay, let's kick things off with a totally staggering number, 19.3%. That is their full-year revenue growth. Now, for a mature financial services company that's managing literally billions of dollars in assets, putting up nearly 20% top-line growth is a massive achievement. It proves their core engine is running incredibly hot, even when the broader macroeconomic weather isn't exactly sunny.
And this quote from their MD and CEO, Srikanth Nadella, really hits the nail on the head. He pointed out that despite a very challenging year, they kept delivering strong performance. Honestly, between geopolitical stress, shifting asset classes, and corporations hoarding cash, it was for sure a tough market. But despite all of that, they still expanded their market share and just kept winning new asset management mandates left and right.
All right, here is our roadmap for today. First up, the big picture. Second, the domestic engine. Third, going global with Ascent. Fourth, margins and the financial bottom line. And finally, number 5, future outlook. Let's dive in.
Section 1. The big picture. We're going to visualize KFin Tech's core components and see exactly what makes up their revenue.
When breaking down the Q4 revenue mix, domestic mutual funds are absolutely still the foundation, pulling in a hefty 61% of the total. But the real standout is Ascent, their newly acquired international business. It is already grabbing a massive 15% of the pie. Throw in issuer solutions at 10% and things like alternative investments making up the rest, and you've got a rapidly diversifying business. But make no mistake, domestic mutual funds run the show.
Moving right along to Section 2, the domestic engine, focusing on mutual funds and issuer solutions.
Now, things get super interesting and a little complex when we look at their domestic growth. There's a really stark contrast here. Assets under management skyrocketed by 21%, which perfectly matched the industry. But domestic revenue only grew by about 11%. Normally, managing more money means making more money at roughly the same rate. So what exactly is causing this massive 10% gap?
Well, here are the culprits. KFin Tech faced some serious market headwinds. First, mark-to-market erosion knocked down equity valuations. But the really fascinating part is the asset mix shift. Investors basically flooded into passive metal ETFs like gold and silver, which carry a much lower yield for KFin Tech compared to active equity funds. Add in an exodus of retail investors that resulted in the loss of 1.7 million folios, plus some incredibly sluggish corporate actions, and boom, that's why revenue lagged behind total asset growth. But hey, there's good news. Early data shows these headwinds are already reversing. Going into April, that aggressive rush toward lower-yield ETFs started cooling off, and actively managed funds are bouncing back. So if retail investors jump back into the secondary market as expected, we are looking at a serious yield recovery in the coming quarters.
All right, Section 3, going global with Ascent. This is their strategic international play and easily their most exciting growth vector.
And wow, the metrics from Ascent are moving at a blistering pace. They just added nearly 500 new fund manager clients, pushing their total active funds to roughly 900. And they aren't just snagging small accounts. They landed 6 massive contracts for funds with over $100 million in AUM. Operating across 18 countries now, this engine is driving a massive 25 to 30% year-over-year revenue expansion.
Section 4, margins and financial bottom line. Let's talk about the actual cost of this fast expansion.
So all this rapid international growth has a catch. It's temporarily dragging down overall profitability. The core, standalone KFin Tech business runs at a stellar 43.5% EBITDA margin. But when you roll in the newly acquired Ascent business, the consolidated margin drops to 40.7%. It's the classic cost of aggressive expansion, right? You buy a high-growth international company, but it just hasn't hit the massive scale and efficiency of your mature domestic side yet.
To really get why this drag is happening, you have to understand the amortization of intangibles. Basically, when KFin Tech bought Ascent in Singapore, they paid for non-physical assets like brand value and existing client contracts. Accounting rules force them to gradually write off that cost over a decade, so they take about a 6 crore rupee hit on paper every single quarter. It suppresses their reported profits, even though the actual cash flow and underlying business are completely booming.
And that is exactly why patience is key here. Ascent's margins are sitting at 8% today. But
As those massive $100 million contracts go live and operational leverage really kicks in, management expects that margin to jump into the early teens by next year. The ultimate goal? Pushing Ascent past a 35% margin in the next 3 to 5 years. Once those initial acquisition costs fade, that profitability gap is going to close fast.
Which brings us to Section 5, Future Outlook. Let's look at their projections and their big diversification goals.
They are laying down a super confident baseline for FY27. Even factoring in a conservative view of the volatile markets, they are projecting up to 24% top-line revenue growth and 16 to 17% EBITDA growth. And get this, they expect organic international growth to blast past 60%. They're making a massive bet that their tech, combined with a new global footprint, will absolutely dominate.
And they aren't just sticking to the usual playbook either. Check out these next-gen growth vectors. First, they are operationalizing their new K platform to help the finance ministry track down unclaimed national assets. Second, they are building a highly complex, direct integration with Aladdin, the world's biggest risk management platform. And third, they are taking their corporate registry tech straight into the massive SME market.
All right, which brings us to the biggest takeaway of the day. The magic number? 58%. Right now, exactly 58% of KFinTech's core technology revenue is still heavily tied up in domestic mutual funds. It's a fantastic, mature business, but it definitely leaves them exposed to local market swings and the moods of retail investors.
So, the ultimate strategic goal? Rapid diversification. Management wants to push that 58% domestic reliance below 50% as quickly as possible. And given that 60% expected growth in their international divisions and huge new integrations on the horizon, it leaves us with a fascinating question. How fast will this global expansion completely transform the company's core identity? Are we watching a domestic powerhouse turn into a global giant right before our eyes? We'll just have to wait for the next earnings call to find out. Thanks so much for joining us for this explainer, and we will catch you next time.